Hey, good morning, everybody. It's Tuesday, June 23rd, 2026. I, of course, am Hammer, founder of Hammer Solutions, home of great products such as Originator Success, Grab and Go Social, and Raid Sensei. Excuse me. And you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, where we talk about what's going on with rates and pricing in the markets. If you're here this morning, say good morning. If you're watching on the replay, do me a favor, give me a hashtag replay in the comments. Let me know that you were here. Remember, if you would like to join me live, and you don't want to miss a moment of the show, sign up for the text reminders, hmmr.io/reminder, or use this cool QR code over here. If you're on your phone, take a screenshot, go back to your photos, press and hold that QR code. It should load for you and load the page. So anyway, I'm going to do it a little bit different this morning. We're going to, I'm looking to see when the numbers kind of hit. I got to send the text out a little bit earlier. It's got to hit through all the people. So, but I do, live on Facebook instead of YouTube. Couldn't get your app to open this morning. I will keep an eye on that, Holly. Thank you. Megan Bissell, good morning. We'll see if anyone else joins from YouTube. I'll see the little indicator. So anyway, I am considering changing up. I think I'll probably do everything at the beginning to give time for the live people to get on. I was trying to do something, make it a little more replay friendly as well. When we're doing this. But anyway, if you're here this morning, say good morning. If you are watching on the replay, do me a favor, give me a hashtag replay. Remember, you can also sign up and get the email lock advice to your inbox each and every weekday morning. You can sign up there at ratelockadvice.com or use the QR code on the screen. You should also consider signing up for our text alerts. They're a whopping $7 a month. And they will help you to protect your pipeline, give you a morning alert, an afternoon alert, and alerts when reprice risk is high, hopefully to help you get in front of reprices for anybody except for Provident and UWM, because they reprice so damn fast, you can't keep up with them. No service really can, because if I were to trigger on those, it would be a lot of false positives for everybody else because they just seem to do it super crazy. Ron Siegel says today is National Detroit Style Pizza Day. He's very disappointed that he missed National Chocolate Eclair Day while in the hospital yesterday. Well, that's easy, Ron. Don't go to the hospital. What happened, my man? I hope you are doing well. I hope when you were in the hospital, it was something minor. And I hope you are feeling okay. I know you've been working on your health. So as far as Detroit style pizza, I know there's Chicago style pizza, Detroit style pizza, New York pizza, or what we used to call Sicilian. I think Detroit is a deep dish, isn't it? Detroit style pizza. If anybody knows, let me know in the comments. Ballast Spot. What is my outlook for the rest of 2026? I would say you got to use a wider range when you use a longer time frame. We're very much high fives, low sixes, mid sixes, very much where we're at now. It depends on if we were to see anything pop with the credit bubble. A lot of people are spending a lot of money that they don't have. As long as that continues to happen, that will keep the economy propped up. If we were to actually fall back to a credit crunch like we saw, it started out in housing, but it worked its way into everything back in 2008. That would, of course, crush everything. But otherwise, I think realistically, high fives, mid sixes for your, basically most of your loans, even govies and all that. I don't think we see the move too much lower anytime soon. I do think we are at risk of a Fed rate hike, but I don't think they're going to come up with one yet. So that's, longer for 2026. The main thing is people are used to these rates and they're out there looking at houses. So the apps are up and there's good stuff with that. So good morning, Angela. Good morning, Yasmin Martin, Deb Dickinson, Jolyn Goolsby, Kenny Rivard. Great to see all of you here. And Siegel, if you don't answer on here, reach out to me separately and I'd like to hear more about your situation. So, National Chocolate Eclairs are definitely awesome as well. So, all right. Anyway, enough babbling from me. Let's go ahead. Let's jump in and get started. If you guys are ready, let's talk about what we got going on over the next few minutes here. So taking a look here, let's start off with the technicals, where we're at to start the day. Right now, mortgage-backed securities currently up 9 basis points. It's better than a kick in the teeth. It's a little bit of recovery, but it's not really anything great. 4.48, the 10-year treasury yield being below 4.5 is definitely something to keep an eye on. We're glad to see that as well. So quick recap of what happened yesterday. Let me see. Let's go ahead and we'll zoom in on that chart here. So really, if you look at yesterday in the context of just yesterday, everything was flat. If we look at it with the 5-day, you can see a better idea of what happened here. We had a big drop. Remember, we ended last Thursday here. We started on Monday down here. So big drop on the day. There was a big negative drop right here. But once we had that drop, as far as where things went yesterday after we did the show, we ended just a couple basis points lower than where we were at when pricing came out. Not enough to see any changes. There were no reprices. There was really nothing on here that we had to worry about for any of that. As far as rate sheets today, they're going to be unchanged, maybe a smidge better in some scenarios. Right now, mortgage-backed securities, they're up a few basis points higher than at 10 a.m. I mean, but it's a very small difference. You can see it here. It's really not much at all. So very unlikely to see much of a change. When we take a look at where that looks, rate sheets yesterday ended at 6.66. So the sign of the devil. We saw that back on June 5th. And again, as far as where rates have gone, looking in the last month, you're going from 6.61 at the end of May to 6.58 to 6.66. I mean, we have not seen much movement at all in rates. You're kind of trying to catch rate pricing on a good day, but there's really not much of a change here. It's been very, very stable, very flat overall with this. So, reprice risk on the day is low. It's unlikely that we have to worry about anything that is going to trigger reprices today. We got a 2-year Treasury auction later this afternoon. The ADP job numbers, the weekly job numbers that ADP does now came out, showed a little bit more job strength, 30,000 private payroll jobs. And it was first time, I think, since May 5th that there's been an increase. So a little bit there. As far as lock advice goes, cautiously floating. We're just not going to see, actually, let me take off on that. Let me be more specific. Anything that's closing in less than 15 days, I'd actually consider locking, right? So I actually should have moved that around. Rates aren't likely to move much in the next couple of weeks, especially with less of a positive response to the reopening of the Strait of Hormuz than we were expecting to see or hoping for. Now, part of that is because there has been plenty said that it will take months to see traffic increase. There's a lot of concerns. There's still mines out in the water, boats, vessels, ships. These vessels are not sure who is really in charge. This is supposed to be maritime law with free international waters, and yet, they're concerned that there could be some military action. Things are kind of going slow. So more ships are transiting the Strait of Hormuz with their satellite signals switched on, pointing to growing confidence among ship owners and traders about sending vessels through the world's most important energy choke point. 7 tankers, including 2 fully laden non-Iranian supertankers, were either in the strait or had already crossed on Tuesday, according to vessel tracking data compiled by Bloomberg. Remember, they're in front of us. That's why. So when they crossed on Tuesday, and it's only 10 o'clock in the Eastern time here, all of them were broadcasting their location. The shift reflects a degree of strengthening confidence among ship owners as Iran is expected to refrain from targeting vessels. So as that increases, that's good news. It's helping things like oil prices to continue to drop. You got Brent crude at 76.94. It is, falling steadily here, kind of staying low. We saw it drop down to 78.96. Then it was up a little bit. Then it has dropped 77, now 76.92. When you take a look at WTI oil prices here, they are at 72.95. Again, also falling to lows. However, I would say that more of the reaction that we've got, that bonds are up a few basis points, are probably due to stocks taking a bath because of South Korea, the Korean market, South Korean index, where Asian chip makers were having a problem. Tech is leading the market slower as heavy sell-off in Asian chip makers, including 10% drop in the South Korean Kospi index, is dragging broader equity markets lower amid valuation and capex worries. part of the problem here is, there's a lot of concern that this could be an AI bubble similar to the tech bubble back in the 90s. So that's kind of the concern with what's going on here, 2000s. That when was that tech bubble? So anyway, there's concern here. So there's a little bit of weakness. I think you see a little bit of money in bonds because of that, but overall, not a huge, there's really not a huge increase. Being up 8 basis points, very much in that same range that we've seen bonds at. Thankfully, not moving all the way down to the low point that we saw over here. We did stop a little bit higher than that, but they're bouncing up, but nothing really to get excited about. So anything in the next 15 days, I would lock, because there's just nothing clear that we're going to see an improvement. Again, we didn't see, I was expecting to see a stronger reaction with the Strait of Hormuz opening. We were expecting to see, rates drop an eighth to a quarter point, and they really just haven't. One more time, bringing it up here, we're really just still in that same range. We were right here at the same level on June 5th. And here we are, June 22nd. Same number. So it's kind of as far as anything closing the next 15 to 30 days, that's farther out. You're now looking at into July. We've got the BLS jobs data. It's going to come out on Thursday, July 2nd, rather than on Friday, July 3rd, because Friday, July 3rd will be the observance for the 4th of July. When the 4th of July falls on the weekend, everybody gets to take off on Friday. So we'll see that on Thursday. And the reality is, I don't know that it could possibly come in weak enough to create a shift on expectation of Fed rate cuts. And if it comes in stronger, it's probably not going to help. So the reality is that Kevin Warsh, the new Fed chair, after the Fed meeting, really put an emphasis that the Fed is focused on stamping out inflation, and that's what he wants to bring to the Fed, and that he didn't even mention the labor market at all. So it's hard to think that we'll see anything improve there. We've got inflation data coming later this week, the PCE inflation data. I don't think that really causes much of a move. It's kind of a it's kind of already forecast because we know what everything else came in at. But the next CPI one comes out on 7/14, and I don't think we're going to see much help there either. So let's see what my man Mr. Siegel is talking about. He told us Detroit pizza, deep and thick in composition, light and airy in taste, the steel square pans. Yeah, so deep Detroit pizza is what in Jersey what we used to call Sicilian. Give it a unique shape, one of a kind flavor. The square pans were also unique in that they were made from thick steel, more closely resembled cast iron skillet, offering a different shape. The thick steel pans also created a different kind of flavor. Some interesting reports yesterday about the influence Val and Greenspan on Kevin Warsh might lend some insight into the way Warsh will lead the Fed. RIP to Greenspan. Yeah, Mr. Greenspan died. I think he was 100, wasn't he? He was old. Wherever he was old. With the advent of the internet, Greenspan felt productivity would have a positive influence on inflation. It obviously did. Warsh has already spoken on the belief that AI will do the same with productivity and inflation. All the focus groups might give Warsh cover for holding rates through the year. Yeah, and I think that's what we're hoping for, is to see that. But markets are pricing in a Fed rate hike by the end of the year. I mean, they're very aggressively pricing it in. There's only a 15% expectation that rates would stay the same here. So Greenspan was a big believer in less commentary from the Fed is better for markets. Yeah, I mean, exactly. So I know that Warsh believes that same thing, and we'll see. But it's a different time, so I don't know that I agree with that. I liked Powell's speaking. I think that he did fine with that. But anyway, as far as what we got here, let me hit the last one and then we'll wrap it up. As far as 30 plus days out, cautiously float those loans. Why? Because it's very unlikely. I mean, as we've seen, you're just not seeing anything that's a condition where we have to worry that rates are going to really move higher from here. There's not a lot of pressure from that. We don't have to, now that things are settling down, oil prices are coming down. That should help inflation to work its way lower again. And, that should help ease some of the pressure on Fed rate. The idea there'd be a Fed rate hike, which could help mortgage bonds a little bit. So overall, everything's pretty good to that. I think we're very much going to stay in the same range that we are now. So there's really, not much of a reason to be floating most loans except for if it's closing in, 30 days out and you don't want to take that pricing. You don't have to lock for protection, but anything closing the next 15 days, I'm absolutely looking to lock for protection. Why not? Why take that risk is where I would come in on those 15 to 30 days. You can cautiously float to consider locking depending on, risk aversion and things. So, all right, my friends. Well, I think that's it. Thank you for joining me. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time. If you would like a reminder that I am going live, you can get a text so that you don't miss a moment of the show. It's got the links, hmmr.io/reminder, or use this cool QR code. Don't forget to sign up for our written lock advice at www.ratelockadvice.com. Check out our text alerts at www.ratetextalerts.com. Go check out how we can help you get more loans at originatorssuccess.com. Be found, be chosen, be remembered. If you know that you need to be doing more with social media, go check out Grab and Go Social. It's $97 a month, but you can give it a try for $7. One of the things that you can do there now is take the sprints, which will help you get started, get action right off the bat. Go check that out at grabandgosocial.com. So anyway, thank you, my friends. I hope you will join me tomorrow at same bad time, same bad channel. I'll see you then. Bye-bye.